The Bitcoin market is approaching a moment that could define the next major move in crypto. Right now, Bitcoin is trading around the $71,000 region. On the surface, the market looks calm. Price has been moving sideways, volatility has cooled down, and many traders might assume that nothing significant is happening. But when you look deeper into the market structure, something very interesting begins to appear. Behind the scenes, large whale orders are building massive sell walls above the market. At the same time, strong buy orders are forming below the current price. This creates what traders call a liquidity corridor, a narrow zone where price becomes trapped between major supply and demand. And historically, when Bitcoin gets squeezed inside a liquidity corridor while leverage begins rebuilding in derivatives markets, the result is often explosive volatility. So the big question right now is simple. Is Bitcoin preparing for a breakout towards $75,000, $78,000, and possibly $80,000? Or is the market setting up for a liquidity sweep that could send Bitcoin back towards $70,000 or even $69,000 zone before the next rally begins? To understand what might happen next, we need to examine three critical forces shaping the market right now. First, whale order activity and liquidity zones. Second, the return of leverage in derivatives markets. And third, the psychological battle currently taking place between buyers and sellers around key price levels. Let's start by looking at the current price environment. Bitcoin is trading near $71,700. Over the past several days, price has been moving sideways inside a relatively tight range. Unlike earlier periods of strong volatility, the market now appears to be consolidating. But consolidation does not mean inactivity. In fact, consolidation phases are often when the most important positioning occurs behind the scenes. During these periods, large institutions, whales, and professional traders carefully place their orders, build positions, and prepare for the next move. One of the best ways to observe this behavior is through liquidity heat maps that track where large orders are sitting in the order book. Recent heat map data from CoinGlass reveals something very important. Above the current Bitcoin price, there's a dense cluster of sell orders stacked between $72,000 and $74,000. These sell orders are not small retail trades. They represent large whale-level liquidity walls placed by major market participants. When multiple large sell walls appear in the same price region, they often act as strong resistance. This means that if Bitcoin attempts to move higher, it will likely encounter heavy selling pressure in that area. Buyers trying to push price upward must absorb all those sell orders before the market can break through. And until that supply is absorbed, the price often struggles to move higher. But the story becomes even more interesting when we look below the current price. While whales are placing sell walls above the market, they're also placing buy orders below it. Between $70,500 and $71,000, analysts are seeing a growing concentration of bid liquidity. These buy orders form the first layer of support. If Bitcoin experiences a short-term pullback, this zone is likely where buyers will attempt to step in and defend the market. But it doesn't stop there. Even deeper in the order book, another cluster of large buy orders can be seen forming between $69,000 and $70,000. This deeper demand zone could act as a stronger accumulation area if the market experiences a larger correction. When we combine these levels together, we can see the full picture of what is happening. Bitcoin is currently trading between strong supply above and strong demand below. This forms a tight liquidity corridor where price becomes temporarily trapped between large opposing forces. And historically, when markets compress like this, the result is often a powerful breakout once one side of the range is finally absorbed. But order book liquidity is only part of the equation. The second major factor shaping the market right now is the return of leverage in derivatives markets. Over the past few weeks, the crypto market experienced a significant liquidation event. During that event, excessive leverage was flushed out of the system. Many over-leveraged positions were liquidated as the market corrected. This type of reset is actually healthy for markets. When leverage becomes too high, it creates instability. Liquidation events remove that excess risk and allow the market to rebuild on a stronger foundation. And now, according to derivatives market data, leverage is slowly returning. Bitcoin's open interest, which measures the total number of active derivatives contracts, has climbed back toward approximately 88,000 BTC. This is an important signal. When open interest increases while price is also rising or holding steady, it usually means that traders are opening new positions. In other words, new money and new leverage are entering the market. This is different from a situation where open interest falls while price rises, which would indicate that traders are simply closing positions rather than opening new ones. Right now, the data suggests that traders are actively rebuilding leverage. This means more long and short positions are being created across derivatives exchanges. And when leverage builds up inside a tight price range, the market becomes increasingly sensitive to sudden moves. Even relatively small price changes can trigger liquidations, and when liquidations begin, they can create a cascade effect. For example, if Bitcoin suddenly moves above a major resistance level, short sellers may begin to get liquidated. When short positions are liquidated, the exchange automatically buys Bitcoin to close those positions. This forced buying pushes the price even higher, which can trigger even more short liquidations. This chain reaction is known as a short squeeze. Short squeezes can cause extremely rapid upward price movements, but the same process can happen in reverse. If Bitcoin suddenly drops below a major support level, leveraged long positions may begin to get liquidated. Those liquidations create forced selling pressure, which pushes the price even lower and triggers more long liquidations. This creates what traders call a long squeeze. Because open interest is rising while Bitcoin trades inside a tight range, both of these scenarios remain possible. And this is why analysts are watching the current liquidity zones so closely. The next major move may not simply be a slow trend. Instead, it could be a fast, liquidation-driven breakout. Now let's combine these two pieces of data, whale liquidity zones and derivatives leverage, to understand the broader market setup. On the upside, Bitcoin faces strong resistance between $72,000 and $74,000. This zone contains multiple whale sell walls. If buyers manage to absorb this selling pressure and push price above $74,000, the market could trigger a wave of short liquidations. In that scenario, Bitcoin could rapidly move towards $75,000 as the first immediate target. If bullish momentum continues, the next levels traders are watching include $78,000 and potentially the psychological $80,000 level. Psychological levels like $80,000 often attract significant attention from both traders and the media. Breaking above such levels can generate strong momentum as new buyers enter the market. But the bullish scenario depends on one key condition. Bitcoin must successfully break through the $72,000 to $74,000 resistance zone. Until that happens, the sell walls in that region remain a barrier. Now let's examine the downside scenario. If Bitcoin fails to break above resistance and buying pressure begins to weaken, the market could rotate lower. In that case, price may move toward the 70,500 support zone, where the first layer of buy orders exists. If that support holds, Bitcoin could simply continue consolidating inside the current range. But if selling pressure increases and that level breaks, the market may move deeper into the 69,000 to 70,000 demand zone.
This region represents a stronger accumulation area where whales may be willing to buy larger amounts of Bitcoin. In many cases, markets temporarily sweep below support levels to trigger stop losses before reversing higher. This process is known as a liquidity sweep. Liquidity sweeps are common in highly leveraged markets because they allow large players to collect liquidity before pushing price in the opposite direction. So if Bitcoin briefly drops towards $69,000, it does not automatically mean a bearish trend has begun. Instead, it could represent a temporary liquidity grab before the next rally. Understanding this behavior is crucial for traders because markets rarely move in perfectly straight lines. Instead, they often move in ways that maximize liquidity and force weaker positions out of the market. Another important factor to consider is trader psychology. Right now, many market participants are uncertain about the next move. Some traders expect a breakout toward new highs. Others believe the market needs a deeper correction before the next rally. This uncertainty actually contributes to the formation of tight trading ranges. When buyers and sellers are evenly matched, price tends to consolidate until a stronger catalyst appears. That catalyst could come from several sources. It could be a large institutional order, it could be macroeconomic news, it could be a sudden shift in derivatives positioning, or it could simply occur when enough liquidity builds up to trigger a cascade. Historically, Bitcoin has often experienced its largest moves after long periods of compression. These quiet phases can last days or even weeks, but once the range breaks, volatility returns quickly. This is why experienced traders often pay close attention to consolidation patterns. They understand that calm markets can suddenly become extremely volatile. At the moment, Bitcoin appears to be entering exactly that type of environment. Leverage is increasing, liquidity clusters are clearly defined, and price remains trapped between strong support and strong resistance. All the ingredients for a major move are present. The only question now is which direction will break first. If buyers absorb the sell walls above $74,000, the market could rapidly transition into a bullish momentum phase. Short liquidations could accelerate the rally and push Bitcoin toward higher price targets. But if sellers manage to defend that resistance and push price downward, the market could temporarily sweep liquidity below $70,000 before stabilizing again. Either way, the current setup suggests that the next significant move may not be far away. For now, traders across the market are watching several key levels very closely. The 72 to 74,000 region remains the most important resistance zone. Breaking above it could unlock the path towards $78,000 and beyond. On the downside, 70,500 represents the first support level. If that level fails, attention shifts toward the 69,000 demand zone, where stronger buying interest may appear. As open interest continues rising and leverage rebuilds across derivatives exchanges, the market becomes increasingly sensitive to movement around these levels. And when liquidity becomes tightly concentrated like this, even a small spark can trigger a large reaction. So while the market may appear calm right now, the underlying structure suggests that volatility is quietly building. Bitcoin may be entering the type of environment that often precedes the next major breakout. The coming sessions could reveal whether bulls are strong enough to push price above resistance, or whether the market first needs a final liquidity sweep before the next rally begins. Either way, the battle between whales, leverage, and liquidity is setting the stage for what could be the next defining move in the Bitcoin market.